Hello, everyone, and welcome to Financial Accounting. Today, we're going to look at the basic financial statements and learn how they are integrated. Financial statements report the financial condition of a business at a point in time and changes in the financial condition over a period of time. The four basic financial statements are income statement, retained earnings statement, balance sheet, and statement of cash flows. Please note that some textbooks only mention 3 financial statements as basic financial statements. They don't include the statement of retained earnings because retained earnings are reported on the balance sheet. The income statements summarize revenue and expenses for a period of time in order to determine how well a company has performed and achieved its objective of generating profits. The time period covered by an income statement may vary depending on the needs of the stakeholders. This time period may also be called the fiscal period. Companies may issue financial statements monthly, quarterly, or annually. Many companies use calendar year. A calendar year, as you would expect, covers 12 consecutive months, beginning January 1st and ending December 31st. A fiscal year consists of 12 consecutive months that don't begin on January 1st or end on December 31st. For example, July 1st of the current year through June 30th of the following year. A fiscal year also can include periods of 52 to 53 weeks. This might not end on the last day of the month, but instead might end on the same day each year, such as the last Friday in March. Let's take a look at the income statement of Cisco Systems. It reports the results for years ending July 25th, July 27th, and July 28th. The notes to consolidated financial statements state that the fiscal year for Cisco Systems is the 52 or 53 weeks ending on the last Saturday in July. Fiscal year 2020, 2019, and 2018 were each 52-week fiscal years. While a calendar year end is straightforward and more common, a fiscal year can present a more accurate picture of a company's performance. This often is the case with seasonal businesses. For example, many snow plowing companies make the bulk of their revenue between November and March. Splitting the revenue between December and January to adhere to a calendar year end would make obtaining a solid picture of the company's performance over a single season very difficult. In addition, if many businesses within an industry use a fiscal year end, a company that wants to compare its performance to the performance of its peers probably will achieve a more accurate comparison if it's also using the same fiscal year. Since the objective of business operation is to generate a profit, and profit cannot be generated without revenue, the income statement begins by listing revenue. Revenue is followed by listing the expenses incurred in generating the revenue. By reporting the expenses in related revenues for a period, the expenses are said to be matched against the revenues. When revenues exceed expenses, the company has net income. A net loss results if expenses exceed revenues. The goal of a company is to maximize net income or profits. Businesses might survive net losses in the short run, but since the net loss decreases the overall assets of a company, in the long term, a business must earn net income to survive. Let's look at the sample company's financial statements. During the year, the sample company generated sales of $6,644,000,000. Following the revenue, the sample company's expenses are listed, which include cost of sales, selling and administrative, interest, income taxes, and other expenses. During the year, the sample company earned net income of $661 million. The net income can be considered good or bad, depending on the user. A creditor might be satisfied that the net income indicates sufficient profitability to repay an obligation. However, a stockholder may be disappointed that the $661 million of net income on over $6 billion of sales is not as successful when measured against a competitor's performance. In the current year, the sample company began the year with $4,708 million in retained earnings. The $661 million of net income is the same net income amount reported on the income statement. During the year, the sample company also declared dividends of $341 million, resulting in $5,028 million of retained earnings at the end of the year. A balance sheet reports the dollar amount associated with the assets of a company and the sources of financing of those assets. A business can be financed by borrowing or owner investment. The balance sheet must therefore report the financial condition of a company at a point in time. The balance sheet is represented by the accounting equation of assets equal liabilities plus owners or stockholders' equity. The balance sheet of the sample company shows total assets as of December 31st of $4,754 million. Total liabilities at the same point in time amount to $3,706 million, and total stockholders' equity is reported at $1,048 million. Total liabilities and stockholders' equity add up to $4,754 million, which is equal to the total assets. The accounting equation balances assets equal liabilities plus owners or stockholders' equity. The balance sheet is prepared by listing the accounting equation in a vertical rather than a horizontal form using the following 5 steps. For preparing the balance sheet, each item under asset, liability, and stockholders' equity is listed and added to arrive at their respective total amounts. The total of the liabilities and stockholders' equity must equal the total of the assets. The statement of cash flows reports events that reflect a company's cash account during a fiscal period. The statement of cash flows is organized to run the 3 business activities: operating, investing, and financing. The net cash flows from operating activities are reported first in the statement of cash flows because the cash flow from operating activities is a primary focus of many of the company's stakeholders. Creditors use cash flows from operations to assess if operating activities are generating enough cash to repay future obligations. In the long term, a company cannot survive without generating positive cash flow from operating activities. The net cash flows from investing activities are reported second because investing activities directly impact the operations of a company. Property, plant, and equipment can provide the foundation for operations in a growing organization. Investing activities can involve the acquisition or sale of long-term assets for cash during a period. A rapidly expanding company would expect a negative cash flow from investing activities. In contrast, a company that is downsizing or selling off assets or segments of its business would expect positive cash flows from investing activities. Financing activities are transactions between the company and its creditors and owners. Cash flows in when cash is borrowed for a long-term financing objective, or stock is issued for cash. Cash flows out when a debt is repaid, dividends are paid, or stock is repurchased. During the year, the sample company's operating activities generated a positive cash flow of $1.095 billion. The sample company's investing activities used $473 million, primarily to purchase property, plant, and equipment. The sample company's financing activities used $587 million of cash, primarily due to repayment of debt, payment of dividends, and repurchase of stock. The sample company received $380 million by borrowing from creditors. Overall, during the year, the sample company's cash balance increased by $35 million to arrive at ending cash balance of $728 million. Another way to look at this statement is that the sample company generated $1.095 billion of cash from operations, which they used to expand operations and pay creditors and stockholders. The sample company appears to be in a strong operating position. Preparing the financial statements in the order of income statement, statement of retained earnings, balance sheet, and statement of cash flows is important because the financial statements are integrated. Net income on the income statement links the income statement to the statement of retained earnings. Then the final retained earnings balance from the statement of retained earnings is also reported on the balance sheet. Now let's look at how the four statements are linked together. The first link shows the net income of $661 million on both the income statement and the statement of retained earnings. The second link then shows the ending retained earning balance of $5.028 billion, both on the statement of retained earnings and also as a part of stockholders' equity on the balance sheet. Finally, the third link integrates the balance sheet and the statement of cash flows by the cash balance of $728 million. Thanks for watching this video. Don't forget to like and subscribe. More videos are coming soon.